We got Fook Hien, Senior Investment Strategist at Standard Chartered Bank, joining us to take us through what he's making of things. Fook, great to have you with us here, as always. Appreciate it. Now, the US is it running into just regular month-end sort of slight selling pressure on the equity side, or what do you make of it, the price action in the last 2 days?
Yeah, I mean, obviously, we think the positioning in the US is slightly stretched. It has come off a bit, actually. But then we saw very, very strong earnings last week. And market made all-time high, not just in the US, but in Europe and Japan as well. All are great all-time highs. I mean, the US, we think it is coming down a little bit of consolidation. We've got a PCE numbers coming in later. We're going to watch that. But the view is still very supportive, and we think over 6 to 12 months, it's still in terms of the earnings growth that we are seeing, the theme that we like, in terms of the semiconductors and AI investments, there still continues to be a driver over the next 6 to 12 months, we believe, for the US markets. But in the very short term, positioning has been elevated. We think it has come off a little bit, but positioning is still looking slightly stretched in the US.
Okay, positioning is looking slightly stretched in the US. Fook, hi, good morning. You have a very interesting report, and you point out in the report that there could be a leadership switch to the Japanese market. You talk about how Japan looks to be a serious contender to outperform the US for the rest of the year. This is despite the rally that we've seen in Japan, is it?
Yeah, that's right. That's right. I mean, between US and Japan, I mean, those are our preferred markets. What we see in Japan that's interesting is that there's a lot of foreign flows or non-domestic flows going into the markets. We think it is still under-owned. And historically, when you see these flows come in, it can last for many months. So as the money comes in, we think that's going to be supportive for Japanese equities. Now, why is money coming in? Relatively, we think valuations in Japan are still attractive. The balance sheets in Japan are still very strong, and so they are able to sustain the share buybacks and the dividends if they want to. And that is a key question. Will they really do that? And we see signs that with corporate governance improvements, encouragement from the Tokyo Stock Exchange, that's all pushing companies to do more shareholder-friendly policies in terms of returning cash to shareholders. So all this is enticing investors. Of course, the geopolitical risk, relatively lower risk than other parts within Asia. So that's why we think money is coming in. And if this continues for the next few months, well, we do expect Japan can outperform global equities in the next 6 to 12 months, yeah.
All right. Hi, Fook. Morning. Good to see you. So we've spoken about the developed markets, but post the Lunar New Year, the Chinese markets are showing signs of making a comeback. Do you all have a tactical call that maybe in the near term, that market's bombed out, data points looking absolutely horrific, but you have valuations that are supporting? And in the last couple of weeks, I think so, post the Lunar New Year, that market has actually outperformed a couple of other emerging as well as global markets. Do you think it's time to start looking at China, and that's a tactical call?
Yeah, I mean, absolutely. We think there is a rising chance there's a tactical upside in China. We saw that the travel over the Lunar New Year, that was very strong. Domestic travel was very strong. Also, if you look at visitors numbers into Macau, it already surpassed 2019. In fact, as far as records go back to 2017, they had the most visitors in Macau. So we're seeing a bit more of the consumption story coming back. So tactically, we do like consumption-oriented sectors in China. But over the longer term, we're still looking for more significant improvements in terms of the policy. Because if you look at house prices, I mean, in 80% of the cities, house prices are still falling. There's still a big dampener on a mood and the business sentiment in terms of the property and construction market. But look, we've got the NPC meeting coming up on the 5th of March. We do expect more policy developments to be coming out, and that's going to be supportive. And our view for China really is that growth can stabilize. There's a lot of tools available. Growth can stabilize. They're shying away from a big bang kind of stimulus. But as it stabilizes, that could be supportive. Markets are very oversold. Tactically, could be interesting. But over the 6 to 12 months, I would still want to see more significant improvements before we move to any overweight.
Just one final question. You also mentioned in your report that a sector that you really like in the Indian markets is renewable energy. But you know, this space has seen stocks rally quite a bit. Do you think there's more to go?
Well, that's more within the bond space, actually. So within the high yield bonds, when we look at the high yield bonds within Asia, that's one of the areas that we highlight. India renewables, in terms of the high yield bonds, that's very attractive because you see all this huge rally in terms of the high yield bonds and the property developers in China. But what we're telling investors is we're still cautious on that. If you like high yield exposure, there are other areas like India renewables, which we think is very attractive. Also, some areas like Macau gaming, where the bonds there are very attractive as well in our view.
All right, we leave it at that, Fook. Thanks a lot for joining in and stopping by.